on the web. Feel free to send in your questions, and then we will respond to them. Why don't we start with the audience? Go ahead.
Hi, Bill. I have a question about the management of Target as opposed to the board. When you first made the investment in Target, I think your view is that the management team was great, they were great retailers, et cetera. Based on some of the slides that you put up regarding their sales of stock and the actual operating metrics of the company, have you changed your view on the management team at all?
I think the management team is a very strong team. I think Target, in general, has done an outstanding job as a retailer. I'm disappointed. The company has certainly underperformed my expectations in terms of how they've done in a recession. Ultimately, I hold the board accountable for strategic decisions. It was a board vote that led to the type of transaction they did on the credit card side. I think it's a management team that, with a little extra help in the boardroom, some people on the board that perhaps could push back when the company's headed in the wrong direction or can make the board more recession ready, I think that this team can get us where we need to be. But I don't think you can get there without relevant expertise on the board.
Hi, Bill. I'm a little bit confused on the details of your real estate or the land plan. If I think of creating a REIT, I think of putting all the stores in a REIT and then having the retailer pay the rent to the stores, and that way you get a big tax benefit. Because REIT income is untaxed, passes through their shareholders, et cetera. Apparently, your plan differs from this model. Could you please tell me how and why?
Sure. And again, I don't want this to be too much about the REIT plan, because this is not a slate to push forward a REIT plan. But what we had proposed to the company was we don't like traditional sale-leaseback transactions because we think they put a lot of pressure on a business. You take all of the assets out of a company, all the real estate assets, you put them in another business, you lease them back. Yes, it gives you a big tax deduction, but 20 years later, you got to deal with your landlord. And you can't do, for various tax reasons, leases longer than 20, 25 years. So we looked at that. We fairly quickly dismissed it as not making sense for the company. We think it's very important for Target to control its real estate over a very long period of time. We don't want to put credit pressure on the company. Our revised transaction, we were selling a 20% interest in what we call TIP REIT. We'd own only the land under the company. The rent would be a relatively modest payment compared to the operating income of the overall business. The REIT itself would have a lot more security because it would own the land secured by Target's credit and $20 billion worth of buildings. So there are a lot of benefits to it. But I'm not sure it's the answer for Target. It may be, it may not be. The company's rejected it. All I'm saying is, as a meaningful shareholder of the company, Target is an outlier in terms of ownership of real estate. That may be a good thing. It may be a bad thing. There may be a more efficient way for them to be structured. I'd love the company to take a closer look. And that's my point of view on real estate. But it's not what this slate is about. This slate is about what advice and ideas that Jim Donald can bring to the table, the expertise that Richard Vey can bring to the table when the company's doing a credit card transaction. That's what this is about.
Sure, thank you. Of the 4 areas that you've cited, food retailing, credit cards, real estate, corporate government, Bill, which do you think has been the most severely, the most acute area where, under the assumption that you can't do everything all at once, given that assumption, which would you address first?
I'm going to address corporate governance first. I think it's the easiest to be addressed. Just corporate governance for this company will be fixed the moment that a new set of directors is elected to the board, because I think it will send a message from shareholders that shareholders want a board that's receptive to fresh ideas, wants a board which has meaningful stock ownership. I think you'll very quickly see incumbent directors go out and buy stock in the market because they've been embarrassed once we put up those slides showing them being net sellers of several $100 million worth of stock in the company. So that's an easy change. Change can happen instantly. Ron, do you have any points of view on that?
At this point, the critical thing is to keep in mind that this slate brings ideas into the boardroom, but it brings ideas into the boardroom that get realized only if it persuades 8 other people to go along with it. That is, this is not a situation in which someone is coming out into the boardroom with a set of plans that they're going to impose, but rather it makes the existing directors more effective. And in that respect, I think Bill is right. There's a major impact as soon as that structure goes into place.
But each of them are worth a look. On credit cards, the world has changed a lot since we originally spoke to them. Not clear what kind of credit partnership transaction can be devised. But I don't think the right answer is what we've done is the only right decision. I think it's worth some analysis. I don't think any of us here can tell you with certainty what the right thing to do is on credit cards, what the right thing to do is on real estate, what the right thing to do is for the retailer. But what I can tell you is the people here have the expertise that if they were to join the board, they could help the company analyze each of these various businesses and provide perspective. I mean, Jim, do you want to present, how do you, if you were on this board, how would you work with Greg? How would you work with the rest of the board to help the company?
In my opinion, and Ron can correct me on this, the role of a board member is that of a coach. It's not necessarily tactical, but it's more strategical. And having experience at growing supercenters, having experience in the food business, just having experience as a retailer, I think would be beneficial to Greg, and not only Greg, but his retail team as well. And I'm sure they're getting that coaching and that counsel from their current directors. But again, if food, and from what I read, is where Target wants to go, Greg's been public about that, I think having a director with a background in food could be beneficial to them as they put out their strategy and go forward.
Actually, maybe I think it's a useful question to the full slate. Richard, any thoughts? Day one, you're at a board meeting. Obviously, you know something about credit. What kind of analysis would you do? What would you be interested in learning? And how do you think you could help the company?
As I said at the outset, I think Target is well run from an operating standpoint. It would be a privilege to be in the boardroom. I think my fundamental instinct would be to be supportive. However, I think there are structural issues that need to be addressed, capital structure issues, structure relative to the credit card, and it would be my view that it would be good to surface those issues and begin dealing with them in a systematic way early on.
Michael, thoughts on real estate?
Well, I think the first thing to do is to hear how management views its real estate. I have to give them initially certainly more than a benefit of doubt.